Welcome to Economic Deep Dive, where we break down the world's biggest financial events and hidden economic truths. In today's video, we explore the seven-stage pattern that destroyed 89% of American wealth in 1929, and the shocking reality that we are now entering the same pattern once again. This isn't fear, this isn't hype. This is history repeating itself, step by step, almost as if global markets are following a script written a century ago. Get ready for a clear, powerful, and engaging breakdown that connects markets, money systems, and real-world events into one understandable timeline. Stay till the end to understand the full story. To understand where we are today, we must revisit what happened nearly 100 years ago. The 1920s began with optimism, innovation, new technology, rising wages, and exploding consumer confidence. This was the era of radio, mass automobile adoption, electrification, cheap credit, booming stock markets, and a global belief that the future would only get brighter. Sound familiar? The entire economy began to depend on continuous growth. Borrowing expanded faster than wages. Consumers used credit for the first time to buy everyday goods. Corporations borrowed to expand. Investors borrowed heavily to buy stocks they could not afford. This created artificial demand, and for a while, it made everyone believe they were wealthier than they actually were. But behind the scenes, the cracks were already forming. When too much of a nation's prosperity is built on credit, even a small shock can trigger a chain reaction. What happened next in 1929 didn't come from one single event. It emerged from a sequence of predictable stages that economists and historians have been studying for decades. And the deeper we dig into today's markets, the more obvious it becomes that we are following the same structure, almost point by point. The first stage is always the illusion of endless growth. This is when asset prices go up simply because people believe they will continue going up. Money becomes cheap. Debt becomes normal. The line between investment and speculation disappears. In the late 1920s, this stage was everywhere. Stock prices disconnected from earnings. Corporations took on debt they couldn't sustain. Ordinary workers became investors overnight. When everyone invests with borrowed money, the system becomes fragile. And this is the very environment we saw unfolding in the world between 2010 and 2021. As ultra-low interest rates created a decade of cheap money, record borrowing inflated asset prices and a level of speculation we hadn't witnessed in generations. The second stage is acceleration. Prices rise faster than fundamentals. Investors stop caring about realistic value. They chase momentum instead. In the 1920s, newspapers, radio advertisements, and brokers all encouraged the idea that stock prices could only go and would always go higher. Today, social media, algorithm-driven content, and viral hype have magnified this effect by a factor of 1,000. We watched the same acceleration pattern during the crypto surge, the meme stock frenzy, the housing boom, and the explosion of tech company valuations. When acceleration becomes culture, risk becomes invisible. The third stage is stress. At this point, early signs of weakness appear, but they are often ignored. In 1928 and early 1929, industrial production slowed, crop yields fell, and banks quietly reported higher default rates. Yet the public remained optimistic. Today we see similar stress signals: slowing economic output, rising corporate debt, major layoffs in tech, housing becoming unaffordable, and nations across the world drowning in sovereign debt. But optimism continues because asset prices have not collapsed yet. People take rising prices as proof that everything is fine. But rising prices in a stressed system simply mean the bubble is under even more pressure. The fourth stage is the policy mistake. This is where governments or central banks make decisions intended to help the economy, but end up magnifying the system's fragility. In 1929, the U.S. Federal Reserve raised interest rates to slow speculation. Instead, they triggered a liquidity shortage that made borrowing impossible for millions of investors who were already overleveraged. Fast forward to modern times, and we see the same dilemma. After years of near-zero interest rates, central banks suddenly raised them at the fastest pace in 40 years. Many believed this would gradually cool inflation. Instead, it has strained global banks, crushed housing affordability, increased government interest payments, and pushed nations closer to debt crises. This type of rapid tightening is exactly the pattern economists feared, because historically, it never ends gently. And this brings us to the fifth stage, the stage we are in right now. This is the tipping point phase. This is where confidence begins to break, slowly at first, then all at once. In the late 1920s, this stage lasted only a few months before the entire system unraveled. Banks became fearful. Margin calls increased. Investors quietly pulled money out of the market. Everyone felt something was wrong, but no one wanted to say it out loud. Today, the same psychological shift is visible. The world is experiencing rising bankruptcies, weakening currencies, slowing growth, expanding government deficits, and a global withdrawal of liquidity. Asset prices are wobbling. Markets have become volatile. Investors are nervous. And governments are attempting to reassure the public despite knowing that the underlying structure is unstable. Stage 5 is not the crash itself. It is the moment when denial ends and fear begins. The moment when people start questioning the system they once trusted. History tells us that this is usually the last calm phase before the storm. The sixth stage is the cascade. This is the point where one event triggers another, and the entire financial system begins to fall like dominoes. In 1929, the cascade started with a series of margin calls, which forced investors to sell stocks. As stocks fell, more margin calls were triggered. Banks panicked and restricted credit. Businesses failed. Consumers stopped spending. The economy entered a free fall that wiped out nearly 89% of market value. A century later, a similar cascade could be triggered by any number of events. A sovereign default, a major bank collapse, a liquidity freeze, a housing correction, or even an unexpected geopolitical shock. In a highly leveraged global economy, a single spark can become an uncontrollable fire. The seventh and final stage is the restructuring. After the dust settles, the world attempts to rebuild. This phase can involve currency resets, massive government intervention, new regulations, and the creation of new financial systems. After the Great Depression, the world saw major political changes. New banking rules, new social safety nets, and eventually a redesign of the global monetary system. Many economists believe that our world is inevitably moving toward a similar restructuring whether it involves digital currencies, redesigned banking models, or entirely new forms of global financial coordination. So what does all of this mean for us today? It means we are not watching random events, we're watching history. The same sequence that led to one of the largest wealth destructions in recorded history appears to be unfolding again. We are not in the collapse phase yet, but we are firmly inside stage 5, the tipping point. And while no one can predict the exact moment when the cascade will begin, understanding the pattern gives us the ability to think clearly, prepare intelligently, and avoid repeating the mistakes of those who lived through 1929. Stay alert, stay informed, and stay ahead of the pattern. That is the purpose of Economic Deep Dive. To give you clarity when the world becomes confusing, and to show the historical roadmap hidden beneath today's headlines. If you found this video valuable, make sure to subscribe for more deep analysis, content that helps you understand how global markets, money systems, and MyOR events truly connect.